then I was thinking of something else, which is you guys can see my screen now, right? Okay, nice. So, my name is Sabuj. I am from India. I am, I immigrated here the first time. I came to US in around 2010. My education is completely in India, and here I came as basically a computer engineer developer. But then things actually started uh, moving in the right direction, and then I worked across multiple banks. I have mostly been into asset management on the IT side, but in the later 7, 8 years, starting from around 2012, I was into risk management with different banks and liquidity risk and counterparty risk. That's what I had been doing after that. Did I stop screen sharing? Let me see. Oh yeah, yeah, yeah. My bad. Go live. Okay, I'll turn on my camera also maybe. Video background. Okay. So yeah, so a little bit about me, and then uh, I was working with a company called Cognizant for quite some time, around 13, 14 years. And then once I was waiting for my green card to come, because other than that, you cannot do anything in this country. So once that came, then I changed my job, and then I was working full. My last project was with Wells Fargo, where I was working as a liquidity risk expert. So that is my profile, and I started trading a little bit before COVID started. Okay, and base when I started that, I came in with my own capital. I came in with my own money. I did not know anything about trading, but I was like I was around 5 years younger, right? So the blood was still hot, and I was like that. Okay, if I can if someone other people can do it, I can do it. Okay, let's start. And then within 3 months, I depleted 50% of my whole capital, right? And that was shocking. And so I have seen my ups and downs. I have done multiple courses. I have read multiple books, but nothing was helping me out till I came across this price action concepts, studying the candles. What are the candles telling you? What information can be conveyed out of the candles? How do you understand, or how do you gauge how much probable it is for a move up or a move down? So based on all these things, then I devised my own strategies. I started trading my own way. So I do not go by only by price action nowadays. I am a support and resistance trader, but pay a lot of attention to what the candles are doing on the screen, what price is doing, how price is moving. I pay a lot of attention to that, and especially in the areas where the support and resistance I feel is there, right? And based on that, I take my trades. I do not take my trades randomly. I do not take my trades that hey, there's a green bar, go long. There's a red bar, go short. No, that is not the way to trade price action. Okay, so there are definite rules under price action that you need to understand and then apply those rules. Those anything here? No, I think the camera is still loading. I don't know why, but it is what it is. I'm starting here again. I don't know. If it loads, it loads. Okay. Uh, yeah. So what I was saying is I have devised my strategies around price action, and I I'm interested in spreading that because the more I feel the more I tell things to others, the more things become clear to me, and then others also come back with strategies, with new kinds of findings and all those things. And that's how you build a community, right? So that is my idea. That's my idea behind this. And then Axel told me that he has this server, and he said if I could take some classes here, I agreed to it. So that is how we started, and that is how I am here. Okay, so let's move on. Okay, why trading? Why do I suggest that young people should get into trading, should understand what it is, and then should be able to you should be able to get some money out of the market once you have your concepts in place, once you know what you are doing. At that point of time, you will be able to get money out of the market. It is not a big deal. Okay, once you know how to read the market, once you know what to expect out of the market, at that point of time, you will not be saying that, hey, I am not making money anymore. You will be making it. Okay, but for that, do you think young person age 16 instead of working a job and no college just focus on trading? Oh yes, you can. You can. Even if you are going to college and you are doing a part-time job, you still can focus on trading. You don't have to actually trade. You learn the concepts, you get the ideas, and then after a point of time, you start trading on sim. I will go through all these things. Okay, options, futures. I'll go through all these things. So yeah, I don't know, your name is coming up. Gua pointy cut. I don't know how to pronounce that. But yeah, you can absolutely do that. You can absolutely do that. And I suggest the younger you get into it, the better it is for you. Why? Because you are still in your formation years. Your brain is still young, and it will be very easy at this age to capture things like these. Okay, there are some concepts. It is not absolutely like it's not easy like water. I won't say that. There is a level of difficulty into it. There is a level of complexity into it, but it's not, again, it's not rocket science, right? You don't have to be a major in math or a major in statistics to make money out of the market. Okay, so that's how I look at it. And why I say that you should go for trading is, when I was young, swimming was a life skill, right? That you need to know it. Right now, what I see in the market, I feel personally that you should know how to trade. There are good jobs are going down. Most of the things are going into automation. If you're thinking about, I think about my own career, right? If I was still a developer, which I used to be around 2003, 2004, if I'm still a developer, there may be a big chance that if I am not a star performer or I have not converted myself into an architect or something, ChatGPT has already eaten into my job. I don't have a job anymore. Okay, so the global job market is actually shrinking, right? So it is time to pick up a new skill and not a conventional skill. The conventional skills you will get when you go to college, when you go to school, you go to your classes, you will get your conventional skills. Along with that, it is really important to build on a skill which is unconventional and which is not related to the time that you spend on the job, right? Like in your job, if you're getting a $60 per hour, to make that 500 hours, you have to be at your work, uh, you- at your work for 8 hours to make that money, right? So you cannot do anything in that time. You have to be at your job for that 8 hours. But what this does to you is, you sit down, you have a daily target, you make your money, you go your way, you do something else, and that something else may actually become very productive in your life, right? And do not think that you need to make thousands of dollars every day. No, think about it. $80,000 salary or $100,000 salary that we talk about. Okay, for a beginner, starting from anywhere between 60K to 100K. If you can make a $400 profit every day, it's equivalent to a $80,000 per year job, and then you scale up on it, right? If you manage to make $1,000 every day, you are at a $250,000 salary, and you are doing it yourself at your own convenience, right? Very little capital requirement. There are now funded accounts and all that stuff where you can get money to trade in the market, and that's a completely different industry. If you want, I can talk about it one day. But it is very interesting. Okay, you pay very minimal 30, 40, $50 every month, and you get the capital to play with, and then you go ahead and whatever profit you have, you take the profit out. There is a percentage cut that they keep. On the flip side, you do not have any liability. So they say that your trailing stop loss is $5,000. Even if you lose that $5,000, you don't have to pay it back. So that makes it a lot less risky. But remember, that does not happen for options. That happen for only futures. Okay, and of course, it becomes a potential source of supplement income. right? Now, what I also believe is you have to learn before you can earn it. Think about it. You go to school to become a doctor. You go to school to become an engineer. You go to school to become a CPA, right? But you are learning there. Once you learn, after that, you take all that knowledge somewhere, apply it to earn money, right? Same thing here. Take trading as a career, as a learning, as something that you need to learn first before you go ahead and make money out of the market. Okay. Trading is discretionary also. What do I mean by that? You can go long or short on any instrument at any given point of time if you know that, okay, I have the capability to hold on to this trade, and if it goes in a reverse direction, I will be able to scale in, I mean, put more positions into the market and come out at least at break even, right? If you know where to do that, how to do that, you can go long or short at any point of time, provided your account has the capacity to hold on to that long period of time, right? So whatever trades you take, whatever money, it's your trades. So the decision is completely yours. Remember, the learning never stops. You may go to a course, you may go and learn something somewhere, and do not tell yourself that, okay, I know everything. You don't. Okay. The market has its own way of surprising you every day. Every day. Okay. You will say that, okay, at 11 o'clock, the London market closes, we get a bounce every day. Okay. You have seen it for the last 30 days, and you go long. And that day, the market actually dumps. If you do not know how to manage that trade, you will be keep holding on your trade and you will blow your account, right? So always remember, market has, oh, keep an open mind, keep on learning. When you have made a losing trade, go back and analyze what was there that you did not notice. There will be something. Candlestick charts will give you that information, that what are you missing. It is your job to go back and do the analysis. No one is going to do it for you. Okay. See, it's also a job, right? It's a job that you are doing on yourself. So you have to be diligent about it. You have to be disciplined about it. You have to learn about it. You need to know ins and outs of it. Correct? Again, discipline is the key. Remember, take it as a career. It's not a lottery ticket. Do not be even thinking of this, that, okay, I will come into the market with $1 million today, and in 1 month I will have enough money to buy 4 Lambos. That is not going to happen. That does not happen. Okay. So do not even go there. Go by the simple concept of compounding. My target is $400 a day. My target is $600 a day. What does that translate to? It translates to 80K salary, a 120K salary, right? Now, most of the days, once you're making $400 consistently, most of the days you will make around $600 or $700. Okay, so keep that target in mind, keep a target in mind, and you will get a stage where you will have financial freedom. You don't have to go and work for someone. You'll be confident enough. You'll sit for 3 hours every day, meet your target, go and do whatever you want to do. Compounding is nothing. Compounding is, if you have $2, if you make $2 today, if you make $2 tomorrow, if you make $2 the day after, then after 7 days you have $14 in hand, right? So what I'm trying to say is, if you're making $400 every day, it converts into a 80K per year job. Correct? Okay, let's move on. These are all gyan. Now, pitfalls in the industry. What are the pitfalls in the industry? Greed and overconfidence. Along with that, uh, greed and overconfidence is the source. And what does it result in? Overtrading and refusal to accept a loss. Okay, this is the most important thing that you need to control. You need to control your emotions. Once you have gotten out of a trade and you see that, okay, there is one more bar that has gone up, you are not supposed to get on that bar again. Where is your stop loss? Your stop loss is at the bottom of the swing. So you are practically trying to give away and more of whatever you made in the last trade. Okay, so all of your trades need to have a plan. It needs to have a logic for your entry, And as soon as the logic gets violated, that okay, this logic is not holding anymore, you should not be holding on to that trade anymore. Come out of that trade. You do not have a $1 million account. You do not have a 100K account maybe. So why are you sitting there taking the loss, right? So you need to have a definite reasoning for your entry. As soon as the reasoning is no more there, that should be your stop loss. You can have a money stop loss, you can have a dollar stop loss, you can have a point stop loss, whatever way is convenient for you and your account, right? And then you need to have a profit target. Otherwise, most of you guys play options, right? If you do not take your profit, you know what happens. The next second it becomes half, right? Options, and especially intraday, intraweek options, they have very, very high intrinsic value. And a couple of dollars move in the opposite direction just kills that intrinsic value, right? I do not trade options myself. I trade futures. I trade SPY futures only. Okay. If I trade options, I do not get into intraday options. I do long-term options. Okay, like 6 month expiry, 12-month expiry. I have my not a huge number of contracts, three, four contracts maybe, and then something to offset the loss that I may have. I will keep some contracts on the other side of the trade as well. The other side meaning if I'm thinking that it's supposed to go long, I will keep a short also, and I will keep the short at till my SL level. Once my SL hits, I will come out of the short as well. So that way, what happens is it minimizes my loss. But on an intraday level, doing this much calculation, I am not that fast enough. Let me tell you. Okay, I may know how to trade, but my brain. I'm 43 years old. My brain does not work as fast as it used to do 20 years back. So I try to take the easy way out. Okay, very tempting, too good to be true ads. Grow $100 in $100 to $10,000 in a week. Grow $10,000 to $1 million in a month. Whenever you see such things, just click this. It's not worth it. It is not worth it. Okay, like I was saying, you need 5 years to be a doctor, 2 to 3 years to be a CPA. You cannot become a profitable trader overnight. You need to understand the market. You need to understand how market moves. You need to know how to read candlesticks. You need to understand where are the sellers, where are the buyers, where should I expect a good bull move, where can I expect a good bear move. You need to have those things. Some guy made 1K to 17K. Yeah, ask him after two more. If he's a new guy, ask him after 2 more months what happened to that 17K. Okay, if he has not studied at all, if you have made 1K to 17K by fluke, it will go away in fluke as well. Okay, so let's move ahead. Okay, what is price action? What do you see on a chart? A chart is a representation of a price or of the price against the time, right? You have price and you have time. This is your chart. The chart is giving you the price of any instrument at any given point of time, considering the fact that all other variables are not changing. What are all other variables? It can be multiple things, right? It can be market parameters, it can be some announcement, some government announcement, some policy changes, anything. Considering everything else is constant, at a given point in time, the chart is giving you the price of that specific instrument. Okay, and every tick move or every cent move on this chart is what we call as price action. As simple as that. Okay, there is no other complexity associated with it. Okay, do not dismiss anything on the chart. Okay, look at what happened in the market. Every tick is providing valuable information to you. You see these two tops. Tell me in the chat, does it look like a double top to you? An exact double top or a micro double top? Does it look that way? Okay. The black bar, which is actually a red bar, has actually gone one tick above the high of this. Okay. Yeah, I know. The picture is small. If you look closely, it has the red bar has gone one tick above. It has gone one tick above this bar, right? And then it created an engulfing bar. So what did it do in the process? People who have bought with a stop order here, they trapped them, right? And we came down. So these are the kinds of things that the information that the market is providing to you uh, on a regular basis. You cannot say there is chop in the market. If you say there is chop in the market, I would tell you this is a scalper's paradise. This is absolutely simple. Whenever there is a strong bull bar, bears are selling. Whenever there is a strong bear bar, when it's coming down here, bulls are buying. This is a trading range. The market is trading between these two ranges. If you can make sense of that, you can make a lot of money in this area. And this area was around 15 points. So each side you were making 750 if you knew how to make it, right? Black and white, okay, I do not keep green and red. It's a lot stressful to my eyes. I spend almost 12 hours in front of charts every day. Black is red, white is green. It's much more soothing to my eyes. That's the reason. Okay, and price action is fractal. Whatever I tell you here, whatever concepts we talk about, I will talk about on the 5 minutes. But if you go back to the charts, look at the higher time frames or the lower time frames, you will see the same concepts apply everywhere. Okay, whether it's a 5 minute chart or a 1 minute, 1 hour chart or a 4 hour chart or a daily chart or a weekly chart, you will be able to apply the same concepts across your time frames. Okay. Okay, scalper's paradise. Scalper. Who is a scalper? Scalper is who enters a trade and in 2 3 seconds takes profit and comes out of the trade. That's called scalping, right? Against swinging, where you enter the trade, wait at least for 3 4 candles to see how much profit you can gather from that, right? Okay, let's move. Kinds of bars. In price action, we define bars in just two ways. It is either a trend bar or it is a trading range bar, right? It is either a trend bar or a range bar. Dojis are variations of a range bar. Okay, so what is the difference? A trend bar will have a big body with respect to the whole size of the candle, the range of the candle. No or noticeably small wick on one side. Okay, no wick on this side, small wick on this side compared to the body. Clearly states whether bulls or bears own the bar. So look at this bar. What happened? The bar started here. Bears tried to bring it down. Now, maybe the bears were scalping here. As soon as it hit this area, the bears came out and the bulls jumped in, took it above the open of the bar, and closed it up here. So, bulls started buying here and bought all the way up to the top, and it did not even give me a wick, right? So, which means there were no profit taking on this bar as well. There is no wick. Right? Okay, I'll say what are bulls or bears. Just let me finish this sentence. I'll say what bulls and bears are. Okay, so this is telling me it's a strong bullish candle. What is bulls and bears? Okay, I'll tell you a story also with regards to that. Buyers are bulls, sellers are bears. Okay, now why do you say buyers are bulls? Anyone knows that? Why buyers are related with bulls and sellers are related with bears? Anyone knows? No, it's not because of red. Okay, how does a bull attack? A bull charges at you, uses its horn to pick you up and throw you up. That is why buyers are called bulls, because buyers do the exact same thing. On the other hand, think about bear's attack. Okay, they will come, they will grab you, and they will pin you to the ground first. Okay, their ultimate goal is to pin you to the ground and then do whatever it wants to do with you. That is why sellers are called bears. So instead of buyers and sellers, we say bulls and bears. Okay. It is an analogy actually. That is how it came into being, the bulls and bear concept. Okay, so the range bars. What is a range bar? It has a comparatively smaller body compared to the whole range of it. Large wicks on both sides. These are indecision candles most of the time. If you see it on the chart, these are indecision candles. On the 5 minute chart, these candles act as very good reversal signals. Okay, if you go out to the top, on the top you see something like this or something like this, and the market starts coming down. Yeah, the meeting is being recorded. The market starts coming down, you will actually find that the market is reversing, at least for a little bit. If you take a short there, maybe you will uh, get some profitable trade. But the setup needs to be there. I mean, this candle can happen anywhere on in the chart, right? That does not mean I will counter trend. I will look at this candle, I'll be careful. Okay, if a good bearish signal now comes, I may be trading that. Or after this, if a good bullish signal comes, I will be trading that. Right? And in doji, there are so many different kinds of dojis, right? Some people call this as a doji, this as a graveyard doji, this as a butterfly doji. To us price action traders, these are nothing but a range bar. Same thing happened. The candle opened here. Maybe it tried to go to the top. Bears got it down and brought it down here. The bulls bought it back here again and closed at the same place. Okay, so an indecision candle is something where seeing which you cannot make a decision whether to buy or sell. Okay, suppose you are having a good bull run. How do you know where the candle opened? For a green candle, the open is here. For a red candle, the open is here. So this is the OHLC concept of a candle. For a green candle, open, high, close, low. O, H, low is L, and C, OHLC. That's the OHLC. The wicks mean that, okay, if you see this, at some point of time during the life of this candle, the price went up here. Bulls were able to push the price here. What happened after that? Bears came in or bulls took profit, brought the price all the way down to the bottom. Here, bears took profit or bulls came in and they closed here finally. This is the life cycle of a candle. Same thing happens here. Same thing happens here. Okay, clear? So looking at the bars, traders decide whether the bar had a dominant participant or the bar was one where no decision is being conveyed into the market. Even if you look at only this bar, if you do not have the context on the chart, if you do not know what has been happening, this bar standalone by itself does not convey any information to me, right? It may be a climactic bar and the very next bar can actually trap the bulls here and come back down. So that at those points of time, you will have to be careful that, okay, I have a strong bull bar, but is my market structure supporting the strong bull bar? Is my market structure telling me that it is a strong bull bar and I should go up? Those are the decisions that you need to make. Uh, Alan, these are the indecision bars. Looking at this, you cannot make a trading decision because the candles show that bulls were equally active in all these candles as the bears. So range bars are indecision candles and doji bars are definitely indecision candles. Okay. Moving on, what are some pillars of price action? Price action has two very important concepts. One is leg counting, one is point counting. What is leg counting? What is a leg? Anyone knows what a leg is? Or when does a leg form? Or when does a leg end? Anyone has any idea? No? Okay. Okay. So if you look at this move up, one bull candle, second bull candle, third bull candle, if you see none of these candles till this one has taken out the low of any of the previous candles. Notice that out of these four candles, excuse me, none of the candles have taken out the low of a previous candle, right? This is a leg. Where did this leg end? This leg ended here when this candle took out the bottom of this candle. It can be with a wick also, or at a high the breaking can be with a wick, or the break can be with the body of the candle as well. Two high points, I do not understand that. There is no concept of two high points. We are in suppose we are bullish, okay? We are in a bullish leg as long as one of the candles does not break below the low of the previous candle. It does not need to close below it. Even if this candle had wicked up till here, if the wick was this long and the close of the candle was here, even then we would say that this leg has ended. Okay. And when when will the leg start again? When will I expect the second leg to start again? When you have one candle going above the high of the previous candle. That is when the second leg will start. There's a two legs concept, right? Market, I'm telling you, you have to count legs. Market always moves in legs of two. Okay, always moves in legs of two. If you look here, we have two legs inside this. Look at this. This was the first attempt by the bears to sell. This was your first bear leg that started here. Here, what happened? If you look at a lower level chart, this is a 5 minute chart. If you look at a lower level chart, price went up here. That means in a lower time frame chart, price has actually gone above the previous candle's high. Okay, so one leg happened, the bull leg started, and it came back to give you the second bear leg below the low of this bullish bar. Make sense? You have a spike, you have a two-legged pullback, and then you go back up again. Now, here you will say, okay, at this point, bulls tried to pull in. So let's buy here. No, you cannot buy here right now or when the candle was forming. Why? Because this candle has formed. This is a strong bearish candle. No one in the world can tell you that the next candle will be bullish or bearish, right? No one has that power. No one. If someone says they can see that they are a fortune teller, they have a crystal ball, they do not belong to the earth, or they're lying. It does. What do you mean by it traps the bullish? Okay, so we will go to it. I will show you my setup and everything. We will go to what time frames and everything, all that stuff. Okay, so what happened was we had the two-legged bear move, and then this candle went above the high of this candle again. This was my first attempt of the bulls to reverse these bears. This is the second attempt, and then I will buy on top of this again. Okay, so this is my first entry buy. This is my second entry buy. Price action traders never go for first entry buys or first entry sells. They always go for second entry buys or second entry sales. Okay, now point counting, that was legs. Okay, so as we go through it, this is just an introductory slide that I have today. As we go through it in the subsequent weeks, we will talk more and more about legs, point counting, all those stuff, so you need not be bothered. Okay, then point counting. Every instrument has its own characteristics. Based on those characteristics, the market has decided that okay, for a futures of SPY, which is ES mini, we are scalp 5 points, and our swing will be 20, 10 to 20 points. That's the kind of move ES does on a regular basis. Okay, even if you see here, see 4.6 to 6.3, that was one leg, right? It went up that way, 4.6 to 6.3. So there are certain number of points through which the ES moves. ES initially it's 2 to 5 points. Once it is above 6 points, it goes to 8 to 10. The next level above 12 is 14 to 15. Then it goes to 18 to 20. Above 22, you go up to 25 and then 30. Okay, so this is the way ES moves. I mean, it does not stop at 30, it did not stop at 30. I have seen ES move 120 points in one day. Okay, so it does not need to stop at 30. But you, whatever instrument you are trading, you need to research the characteristics of that particular instrument. You need to know what is the scalp target of this instrument. What is the uh, which one? Whichever instrument you are saying, are you talking about the levels that I was talking of ES or the concept in general? Okay, levels part. For ES, it moves like this. ES is not SPY, okay? SPY is at 500, ES is at 5,000. So, ES, the primary scalp is 2 to 5 points. That's the primary scalp. Above 6 points, it goes to 8 to 10. Once it crosses 12, you will look for 14 to 15. After that, after 14 to 15, it's 18 to 20. Okay. And then after 18 to 20, once it crosses 22, you'll look for 25 and 30. Those are the different levels. So what I'm saying is, as a concept, is that ES behaves this way. NASDAQ has a different movement pattern. Tesla has a different movement pattern. Apple has a different movement pattern. What does that do? What does that tell you? That actually helps you to define where you need to take your profit. Okay, so that is what these characteristics of every instrument gives you. Okay, that okay, I need to take my first profit here. There may be a runner, I may hold a runner, but I will make take some profit here before the market reverses on me, because that is a profit taking point. So you will have to know those things when you are talking about different instruments. What are wedges? Wedges are three touches. Okay, there's a first touch when the bulls tried to go up. Second touch, third touch, we had two-legged move down. See, first leg down, tried to go up, second leg down. This was the two-legged move. Now this first touch, we had the second touch, we had the third touch. Would you scalp here or would you try to hold short? You should just scalp here, because you still have this bottom of the channel support. If it does not break, see, it did not break and it went back up and broke above the wedge. So the concept of the wedge is you need to take profit. Scalp is, again, you enter a trade, you get $100, $150, you're immediately out. You are not holding on to the trade for a long time. Okay, scalpers are in the market between seconds and minutes. Okay, now if you have come here and then here and you get a two-legged move down, you may scalp here on the bearish side by selling, but you are not going to hold it for long, because you know there is support here. You see a breakout candle here, you see there's a gap that has been created between this body and this body, so there's a body gap. So bears will have to do a lot of work in order to turn the market down, right? So the concept of wedges, you need to take profit at wedges, whether it's a up wedge or a down wedge. You need to make sure that you take profit. Once the wedge breaks out, it normally gives you a measured move. What is a measured move? That is also one of our pillars. That if the wedge has started from here, the wedge breakout has started from here to here, where the wedge broke, if I have done this and if the wedge holds, my profit target will be double of this limit. So if this is 10 points, I will get my profit target and another 10 points here. And see, that's what happened. It did go back, but it never went back the low of this. This was the leg that broke out strong. It was just a pullback. It tested this channel, went back up and hit it again. Okay, so this is wedge and this is a channel. The top of the channel creates wedge. In a downward channel, the bottom line of the channel will be able to show you the wedges. Okay, now micro channel. What is a micro channel? Micro channel, these are just concepts. Just take it down, understand it. We'll go through it again later in different time, in different conditions of the market. A micro channel is one. If you're in a bullish micro channel, it's one leg of that channel where none of the bars have come below the low of the previous bar. That's a micro channel. See, one, two, three, four. This is the first time this bar came below the low of this bar. So we have a four bar micro channel here. This is another 3 bar micro channel. This is another 3 bar micro channel. This bar, this white bar, came one tick below the low of this red bar. So the leg ended there, right? And then we went up again. So that is what a micro channel is. What is a break even rule? If you suddenly see a bar like this, okay, there are bulls stuck here, right? Machines try to buy at every condition, under every circumstances, they try to buy and sell. 85% of the market is driven by algorithms and machines, correct? So when we are going up here, there must have been some machines at the top of this. And if you remember, this is that kind of a range bar which I told you often leads to reversal. After this, I got a strong bear sell signal. I will sell below this and come down maybe here, or I would be targeting here, whatever. But see the kind of bars that you are seeing at reversals. Look at these range bars. They are causing reversals. Look at these range bars. Okay, but there has to be a definite point in the market. There has to be a reasoning for you to consider that, to take that trade as a short or a reversal trade, right? So the break even rule is, once these guys have bought here, they will try to buy again here and minimize their loss by coming out at break even. So most of the time you will see when you are in a bull trend and then all of a sudden you see a surprise bar, the first reaction of the market is to buy again, go to the break even area, come out of the trade, or hold on to the trade and try to reach the top of the candle where they actually bought, come out of the uh, original position at break even and make some profit on the second position, the scaled in position that they entered. So that is why all these things keep on happening. This is a fight between bears and bulls. Bears tried to sell, bulls tried to go back up again. They could not. All they got was break even. Bears sold again and we came down. Okay, till where did we come down? We came down to this breakout area and to the bottom of the channel, and that is where the channel got started. Remember, always after a spike, you get a channel. If you don't, then you are creating a trading range. This is a rule. After a spike, there is always a channel. If you're not getting a channel, then you are going to get a trading range. If this used to come, if this came back till this area and bounced again, I would buy again there because we are creating the trading range, right? This is the break even rule. And then range trading is, again, see, after every move up, it's creating a range, moving up, creating a range, moving up, creating a range, moving up. So during this range, you have taken some of your profit here, but you should have a runner to make sure that you do not miss out on this part. Now that will come from, okay, one leg, one touch, two touch. I will have a third touch. Wait for it. Keep a trailing stop loss and hold your trades. Okay, if it breaks even, it held. You will get a 1:1 even if there is a pullback. Okay, so these are the, now if you will hold through the pullback or you will just trade reverse here and try to come down till this point, that's completely your decision. See, again, one leg down, tried to go up, two leg down, and then it started moving up again, right? So this is how ranges and channels work. We talked about the measured move. There are different kinds of measured move. People do 1:1 of the opening range ORB. Opening range ORB means of the first 15 minutes, you draw a top of the first 15 minute, bottom of the first 15 minute, whichever way it breaks out, you try to get 1:1 of that. Okay. Sometimes people do it for 30 minutes. So this is drawn on a 30-minute frame. So I have this range and it went up there and see we got the 1:1 of the opening range, opening 30 minutes range ORB. Okay, so 15 minutes, 30 minutes. There are different strategies by which people trade. So these are not signals or anything, right? These are concepts. Okay, opening range breakout. If I break out of a range, the market will actually try to do a 1:1. They will take the range as the stop loss and they will try to get at least one times that stop loss in the direction of the trade that they are in. Correct? Now, market modes. Everything starts with a breakout. But as soon as we have a narrow, tight, bullish channel, there is very little possibility, very little possibility that it will get converted into an immediate bearish channel. I am not saying it will not happen. I'm saying the probability is less. If it happens, what did I say? Big move up, big move down. will give you a trading range. There will be bulls sitting here somewhere here again to take the market up. But they created the trading range here and they kept on creating higher highs. They created a small trading range here. On top of that, they created another trading range. What did I tell you? That if they enter this trading range, come out of it, then they will try to double this trading range on the top. And see, that's exactly what they did. Okay, and then they created this channel as well. Now look, a channel is a trading range with an angle, with an incline, right? So see, it is going up, coming down, going up, coming down, going up, coming down, but it's making higher highs, which means it is range trading inside this channel, but it is not breaking out of it, and it is in a trading range there. Every time it comes to the bottom, bulls buy. Every time it goes up to the top, bears sell. Now see, a major drop came here. If you see here, first attempt, second attempt, third attempt, this is a micro wedge which is there simultaneously. Yeah, trading range is same as consolidation, it is same as accumulation, it is same as distribution. It's just different terms. See, if you're coming from the ICT background, you've seen a lot of ICT videos. ICT is also price action. It is just the representation of the charts, the concepts. If you go into the depth of regular price action as well as ICT concepts, you will see at the heart of it the reality is the same. It is just a different form of representation. Michael has found his own way of advertising his course. Other people have found out their own way of advertising their concepts. Right? It's still price action. There they talk about fair value gaps. Here we talk about body gaps, which is a little bit different, but the concept stays the same. Okay, so range trading evolves from channels. When there is a tight trading range late in the channel, it normally is a final flag. Do not bother about this now. This is a deeper concept. We will go into it when we reach there. Okay, you have to believe that breakouts fail. Actually, 80% of the breakouts fail. Okay, see, the market broke out. Boom, it came back down. Now what did it do? It created a trading range. Okay, on a 5 minute chart, the trading range can be as short as a single bar. Where is that favorite bar of ours? This guy, see? On a 5 minute chart, reversals or the trading range can be as small as a single bar. That is why it is very important to see where this bar is forming and what is the follow through bar telling you. Okay, every breakout needs a follow through. If you do not have the follow through, it is not breaking out. As simple as that. Okay. And even if it breaks out, breakouts fail. You have to accept that as well. Breakouts fail. Most of the time, breakouts fail. Even if it goes up, it went up two legs up, and that it will come back again to this zone. Now, why are these zones important? Let me tell you that. A breakout is okay. This was my 50% level, right, of this whole move. This candle broke out of that 50% level. So this I would consider a breakout. I would consider this as a breakout of the open of the day. This is my open of the day. I would consider this as a breakout, and I will consider this as a false breakout for now. Okay, we went back up again, went above this, created a strong bar, came back, retested this area, and kept going back up. Okay, that's a breakout. And breakout can be in the positive side, it can be on the negative side as well. Okay, so we are done with this. Let's move. So, what do you need to understand? You need to understand where the bulls and bears are positioned, and that will come only with experience, only with when you have enough screen time to say that okay, this bar is a bearish bar, I will short below it. This bar is a bullish bar, I will go long above it. So, once you have enough experience, enough screen time, enough knowledge, and you know your rules, you are disciplined, you follow your rules, you will be very easily able to tell this. Okay, who is dominating the market, bulls or bears? So based on this is how I create my weekly and my daily plans. Okay, so I'll show you one here. This was my last week's plan. Okay, so I started at the monthly chart. this is my monthly chart. I wrote down whatever I saw in the monthly chart. I wrote the major support and resistances on the monthly chart. Then I did the weekly chart. And then what I'm actually doing is, as I coming down the levels, I am actually finding the points of confluence. Those are high interest areas. If you see your weekly charts measured move and your monthly charts measured move is coinciding at a single point or in a single zone, you know that that will be an important zone to watch out for. Okay, so those are the things that I look for. So I start from monthly. End of I will do it even today tonight. Monthly, then weekly, then I come to daily, then I come to the 1 hour chart, 4 hour chart, then the 1 hour chart, and then I go back to the intraday chart and define my intraday trading plan here. And my plan is actually not to deviate from this plan. This is the commitment that you have to give yourself, because when you are sitting right in front of the market is moving very fast. It is really difficult, especially for beginner traders, to take a decision in that fast moving environment. As a result of which, you need to build a plan. Next day night, after your day has ended, you come back there, you look at your plan, you look at your trades, analyze what went wrong. That will make a better plan for tomorrow. Does that make sense? So this is how I break it down. This is my beginning of the week or beginning of the month thing, and on a daily basis, I start from the daily chart. I have an idea of the weekly and the monthly levels. I start from the daily chart. I come down to 4 hour, 1 hour, and then the intraday plan. Okay, so that is how I trade. That is how I make my plan on a regular basis, and I trade the plan. At the end, can you please go back to the market mode slide? I did not get to finish my notes. Okay, I will. I can share this presentation also. That's not a big deal. There is not enough IP in this that prevents me from sharing it. Okay, and the whole recording will also be there. Okay, now you need to know who is dominating the market, bulls or bears. How do you know that? You look at the left side of the screen. You look out the left side of the screen and decide whether bulls are dominating the market or bears are dominating the market, or are we currently in a trading zone or trading range or going to get converted into a trading range. Looking at the chart, these are the answers that should pop up in your mind. Okay, if you're looking for a reversal, where do you think the bulls and bears have their stops? Where bulls and bears have their stops, that is where the reversals occur. Are we trending or are we in a tight trading range? What is the context? Is the context bullish? Is the context bearish? Or is the context a trading range? Then, if in the context is a trading range, okay, in this trading range, are we currently bullish or are we currently bearish? Or is there still some trading range action that can be expected out of it? Okay, markets have inertia and it resists change. It keeps on doing what it has been doing. That is why to reverse a market, it needs to go through that process of whatever you call accumulation, distribution, consolidation. I call it the trading range. That is why the market needs to create the trading range. If you are trending, markets will keep trending. If if you're in a trading range, market will continue to be in the trading range until and unless bulls and bears are able to come out of the balance zone. What is the balance zone? Both bulls and bears at this point of time believe that somewhere in this trading range, this instrument has its fair value. As soon as some bulls think or some bears think, no, the fair value is far more up or far more down, they put a lot of money in the market. You will see that in the form of bars. You will see when it is coming out of a trading range, it will come out with vengeance. It will come out with a strong big candle, and you know that is institutional money there. But what did I say? Every breakout will need a follow through. If after a big bullish move you get one red bar, no, 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 no. Don't buy there. Wait for more information. Okay. Next, indicators. The holy grail. People keep looking for indicators, running after indicators. Stop doing that. There is no point. Okay. Indicators are just pieces of code that gives an output when some conditions are met. But is the condition coinciding with your context? That's the question. Is the context of the chart telling me to buy? The indicator may tell you to buy, but am I going to buy? Am I going to be the first person to sacrifice myself in the market and buy there and then sit down with a loss and think when it will come back? No. So do not go with indicators that much. Try to understand the market. Try to read the market. Indicators will only slow you down. They may be your walking sticks, but you should get rid of them as soon as possible, because if you don't, you will never learn to run. Okay, most of the time an indicator will give you the signal at the end of a bar, at the end of a trend. The trend has already ended. Think about concepts like, if you are in a trading range like this, between these two lines, it comes down, it goes up, it comes down, it goes up. As soon as it breaks, your indicator says buy, and the very next moment, if you do not know, you will buy here if you do not know the trading range concept. The very next moment it comes back down and hits the low of this box. And then you will say, why? Then, if you go and ask those companies, why did you say, why did your indicator do this? They will say, okay, you have to understand the context of the market. So if I have to understand the context of the market, why do I need to pay you money for the indicator? And if your indicator was so good, why are you not a millionaire? Why are you coming to me selling your indicator for $30 a month? Right? So think about all those things. There is no holy grail. You have to understand, you have to play. Market is fractal, the market is discretionary, your trades are discretionary, it's your decision, it's your trade. Understand the market and play accordingly. No shortcut is going to make you more money in a shorter time frame. There is no other shortcut. Okay, so this is my screen setup. I have a screen set up on 5 minutes, 15 minutes, 1 hour, 4 hours, and daily, and they both look like this. This is the ETH chart. This is the RTH chart. So the futures market is 24 hours, right? The ETH chart starts at 6 o'clock every evening, except Friday and Saturday. 6 o'clock every evening, and closes at 5 o'clock the next day evening. The RTA chart is just a subset of the ETA chart, where we start the market at 9:30 a.m. and close at 4:15 a.m. So on a 5-minute time frame, there are 81 bars to make money. So be patient. Okay. I have 5 minutes, 50 minutes, 1 hour, 4 hours daily, and this is the only indicator that I have, which is the average true range. What is it telling me? What has been the average size of the bar in the last 4 bars? How does it help me? It helps me to if I am deciding a dollar stop loss, if I see that the candle is very big and I need to put a dollar stop loss, I will put my stop loss maybe once or twice the size of the ATR at that given point of time. Okay, and if I am scalping, if the ATR is around 2 3 points, somewhere here, if I am scalping, I would try to scalp one ATR size. Okay, that is how the ATRs help me, because the ATR is telling me that over the last 4 bars, your average range has been 3 points. So there is no point in expecting a 6 point move when you are trying to scalp. You have to come out at the ATR value, right? EMA is exponential moving average. It is, you guys know what is moving average? Put in the chat, you know what is moving average? Okay, moving average calculates the close of the bars. Okay, every 20 bar, the sum of the values of the sum of the closing values of the bars, whether it's bullish or bearish, is added and divided by 20. We move on to the next bar. Again, they pick up the last 20 bars. You move on to the 22nd bar. Again, it picks up the next last 20 bars. And that is how every time a point is created on the chart, right? You join the points, you get your moving average. Is it clear now? It's just an average. Say you are 30 people here or 40 people here, whatever. If I make you stand in a line and say that, okay, I will do a 5 period moving average of your height. So I will go to the first to fifth person. I will calculate your height. I'll make an average. I'll calculate the average. Then I'll go to the second person till the sixth person. I will do the same process again. Add up your height, divide by 5. Then I'll go to the third person and till the seventh person. I add up again. So like this, till I'm not out of the 20th person, I have multiple values. correct? I plot those values on a chart. That is what you'll give your moving average. So it is an average, but since the market is moving, the candles are moving at different points. Your average is also moving. The average is trailing the price. Understood? Apart from this indicators, the rest of the chart is your canvas. Draw your analysis. You will learn a lot more that way. Draw your analysis and then watch whether you made the right analysis or not. If you did not make the right analysis, now is the time to find out what went wrong. Okay, so that is my screen setup. Psychology of traders. I believe in three P's of trading. Okay, this is something that I came up with. Maybe someday some books will write about it. Patience, perseverance, and preservation of capital. Okay, these are my three P's. Other lines on the right chart mean, hold on. Okay, okay. I get your point. Let's go back there once. So I told you, right? 20 MA, 5 minute, 15 minute, 1 hour, 4 hour daily. Those are the different ones. There is an indicator in TradingView which will give you the option to be on the 5 minute chart and plot the hourly, 4 hourly, 60 minute, 5 minute, 15 minute, whatever you want on that chart. So these are the other lines here. Okay. Now coming back here. Okay, so patience, wait for your setup, wait for the market to come to the position where you want to trade. Do not just randomly close your eyes and trade in the market. If you do that, you should be scalping, not holding. If you want to scalp $100 and you say that my stop loss is $300, does it make sense? It does not, right? So do not do that. If you're trying to scalp, scalp. Do not hold it. If you're trying to scalp $100, you should be out of the trade when you are at minus 75 or at minus 100 at max. There is no point in holding on to that trade. Okay. Great traders are disciplined and focused. You have to be relaxed. Do not get into a FOMO. Do not get into hopium. Hopium, what you guys know what is hopium? Hopium is the hope of it's hope and opium mixed together. Okay, you are under the you're intoxicated by hope, so that is what hopium is. When the market is moving against you, you hold on to your trade with hopium on your mind and think, okay, it will come back to me, it will come back to me, and finally what happens? Your options contract has a zero value. Okay, we all have that. The idea of the price action course is to get rid of bad habits and create better habits within yourself. That is the idea of the price action trade. Now also, if you keep on taking low probability trades every time based on maybe the market will go up 5 points, maybe the market will go down 5 points, every time you do this, most of the time you will lose. Most of the time you'll lose this way. So learn the rules, wait for the confirmation, see how the market is behaving, see how it is coming up, then take your trade and respect your stop loss. That is very important. If I put my stop loss here, I'm in a trade, I'm in a short trade, I'm profitable. If I put my stop loss here, suddenly the market turns up here. Maybe I'm in a $50 loss. The market came up to here and you said, oh, let me put the stop loss up. And all of a sudden you are at minus 500. Don't do that. Right? Don't do that. Respect the stop loss. You have put the stop loss there with some thought in your mind. Respect that thought that you yourself thought. Okay. So, way ahead, you need to identify institutional activity, go with numbers, leave emotions outside the door where you are sitting and trading. Every move on the chart can be mathematically counted. Okay. You can count it when the market has happened, but after that, when you keep on looking at the chart, you will be able to say that, okay, if this has come till here, my calculation is telling me it should go till this point, but to go to this point, I will risk this much. I will not risk this much. My risk cannot be double than my profit target, right? There are places where that happens. We will talk about it later. Okay. For now, your risk should not be bigger than your profit target. Be objective and accept that you are wrong. If you are wrong, you are wrong. You can be wrong. We are not inhuman. We are not Martians. We do not know the future. We can be wrong. If we knew the future, we will all be billionaires by now. I won't be sitting here teaching you guys. I'll be somewhere in Maui on a beach. My wife is sitting here. I was trying to say with a couple of girlfriends maybe. Okay, cycle of anxiety and euphoria. So you have to come out of this. Do not get into this. No more FOMO. Okay, no more FOMO. Fear of missing out. If you have missed it, you have missed it. That's fine. The market is here today. The market will be there tomorrow. You will be there tomorrow. If you don't have the money, what will you trade with tomorrow? Okay. Now, keep questioning yourself. Are we in a trend? Is the trend continuing? Is it going to convert into a trading range? Are we in a pullback or are we in a reversal mode? So these questions, even when you are in a trade, keep asking yourself these questions at the completion of every candle. FOMO is fear of missing out. What is that? You see a large long candle, a green candle, you close your eyes and buy. That is FOMO. Okay, you have to think, you have to apply logic. There are 81 bars in the day to make money. You are not going to become a millionaire in one day of trading. Hold your horses, have patience, look what is happening in the market. Okay. News and media. I don't listen to news. Stop listening to news. Market does not work with CNN. Market does not work with any other news reporting channel. These people, whoever the faces that you see on those television screens, they come out with reports which has been prepared by people like you, regular college grads. They have built those reports and given it to him. He is making some sense out of it and trying to feed you some information, getting paid for that. He is not making money trading. Maybe he is, who knows? But his main job, if he was making so much money trading, why will he be in front of the television? My simple question is that if he is so capable, why is he in front of the television? Okay. I make good money trading. I am teaching you guys to make supplemental income. Simple. I take classes to make supplemental income. Everyone does that. The day my trading will give me so much money that I don't have to do anything else, I won't do anything else. Trust me, trading takes me 3 to 4 hours a day. The day that 3 to 4 hours, yeah, I do. The day that 3 to 4 hours gives me enough money that I don't need to do anything else, I won't do anything else. Once my kids go to college, I'll not keep on doing anything else. Okay, I do it because that is one need, and I love teaching. I love talking to people. I love telling people, and then the way people come back with different other strategies based on whatever I said, that is the point of satisfaction for me, which tells me that okay, whatever I said, these guys understood, absorbed, went back, thought about it, came up with something new. Right? That is my satisfaction. Okay, FOMO is a thing, and you will consciously need to come out of it. Okay, so that is what I had for today. Introduction to price action. We went through a lot of topics. We just touched them. There is a lot of depth in all these topics. We will start going through them slowly. In the meantime, if you have any questions, you can ping me directly. I did not even realize. Okay, you can ping me directly. We will. I will definitely answer your questions. If I do not answer it immediately, I will. I'll eventually will. Okay. So if you have any questions, you can drop me a DM. You can tag me here, or if you have any feedback about the class, if you want something else to be spoken, you want some specific topic to be spoken, make sure you let me know that so that I can plan accordingly. Okay. That is all I had for today. See you guys next week.